Good afternoon. My name is Evan. These are my colleagues Tom and Stu, and together we are EST Consulting. We're excited to be here this afternoon to work with Orbis Investments, specifically bringing their revolutionary financial management model of low cost, very approachable and accessible to all demographics, and specifically bringing that model and all the opportunities that it has to the Japanese market. Provided an agenda for you that you can follow along at any point. The primary issue that you brought us in to discuss about was which route should Orbis take in entering the Japanese market, specifically whether building their own operation or trying to look to acquire a firm that is already operating there. A secondary issue that we wanted to also start off by looking at the Japanese market as a whole and whether it's a good opportunity for Orbis to be entering. Before we get into the presentation, I wanted to first introduce you to what we call EST's pillars of excellence. This is what we, in our experience, believe that any business decision that's done in the 21st century needs to take into account effects on prosperity for all stakeholders related to the decision, technology, and building connections in an ever more interconnected world.
Now, before examining the situation as a whole, we wanted to take into account Orbis's considerations and what you're looking for in an investment opportunity. So first, what we noted is that primarily you look to create projects that will pay off in the medium to long term. You're not so much guided by short-term requirements as you are owners yourself of the company and therefore do not need to meet these short-term requirements. Also, contrarianism is at the heart of your organization, and this is something that we took into account with our recommendation. And lastly, the aligning of interests that your organization also fits with its customers along with your employees is a strength that we believe will help you, especially in expanding into the Japanese market. So, no company by itself is, all companies are affected by external factors. So before making any alternatives or recommendations, we decided that it was important to understand the market. So looking at the Japanese market, we noticed that there has been a growing retail investment opportunities. This has been primarily driven by the introduction of the NISAs and growing capital gains, and we believe this has created quite the opportunity which Orbis can take advantage of. We also have noticed that with the Japanese market, in previous experience with our consulting, that this is a very relationship-based market. Trust and cooperation are very important in this marketplace, and this is something that we wanted our recommendation to consider. Now, some threats that we noticed in the Japanese market were, for your organization specifically, is that there are vast cultural differences. Your organization has no experience yet with the Japanese marketplace. And also, there is large existing competition in this industry. With the type of organization that you'd be trying to set up, there are close to 250 other companies which are doing similar activities. And these are, it is important then to differentiate yourself from these competitors.
So just to put some numbers to what Tom has talked about in this opportunity, the current Japanese retail investment market is currently around 1.5 trillion yen. The targeted starting assets under management for this firm will be worked out through the presentation. But I'd like to note that there are about 250 competitors for this retail investment opportunity, and just the sheer size of this market really presents a lot of untapped potential to Orbis, the company, and we are excited to work through a plan to help you realize this opportunity.
So having established that there is, in fact, potential for Orbis in the Japanese market, looking at your internal analysis, the first thing that we notice is that you do have a lot of global expertise. You are operating in in 9 different countries across the globe. And while this does not necessarily help in the Japanese specific expertise, it has taught you that there are certain cultural differences and bureaucratic loopholes that a company does need to jump through when expanding into a new marketplace. We have also noticed that your business model is very performance-based, and we think this is something that will very much help you out in the Japanese marketplace. What I mean by this is that while you and your clientele both share in the good times and share in the bad times, and this, we believe, will really help with that relationship-based marketing aspect that we had pointed out with the Japanese marketplace, as the clientele will notice that you are committed to standing by them even when the market has taken a downturn. You will still be paying them back out of those fees that you had earned before. You will be paying those back out, and in a sense creates a bond and trust between the company and the clientele. Now, some considerations, as I already mentioned, there is a lack of specific Japanese experience that your company will have to overtake, but we believe that this is something that can be dealt with, and we will expand on further in our implementation. Now, some decision criteria when looking at the alternatives we will present are the cost of the expansion, also a strategic company fit. For Orbis to expand into the Japanese market, we believe it's extremely important for it to continue to fit what your organization does so well and why it has succeeded up until this point. And as I've already alluded to, there is a lot of foreign culture risk in terms of the difference in cultures, and this is something that we wanted to take into consideration and make sure that any alternative that we recommend to you would not be bogged down by these decision criteria. So, looking at the two alternatives, the first that we identified was to obtain a Type 1 JSDA license. This would allow you to create your own organization within the Japanese market. Also, another option will be to purchase one company that was pointed out to us was Target Securities Company, and this was one potential target for acquisition, which we will be evaluating further in a moment.
Right. So to quantify some of these alternatives that we have presented, first in the acquisition of the Target Securities Company, we wanted to conduct a valuation of the company. So the main question we're trying to answer here is there currently an underpricing or overpricing in the market? And if so, how can we take advantage of this? So we've done this through two valuation methods. The first one I'm going to point out is a comparable analysis method. So this relies on a relative rating scale relative to a company's peers. And a very important note is that it reflects the current marketplace, which is very important when looking to acquire a firm. Another valuation method we used is a discounted cash flows method. So this involves forecasting out the cash flows that the firm should generate in the future, and also deciding on appropriate discount rates to apply to those cash flows. It's important to note that this discounted cash flow method relies heavily on the assumptions that go into it. So to start with the comparable analysis, the first thing we looked at was the price to earnings ratio of the Target Securities Company. So here you can see it comes in at 9.3 would be the factor. So looking to apply that to a 2015 net income dollar amount, converting that to Canadian dollars using the following assumptions, we get 1.2 million Canadian dollars. So what this is indicating to us right now is that the market capitalization of the company is 11.2 million. So it's important to note that the industry average for price to earnings ratio is somewhere in the neighborhood of 12, a factor of 12. What this is initially indicating to us is that there may be an underpricing involved or present here that the company can take advantage of. So in acquiring a company, just the market capitalization is not the only thing you need to look at. You need to factor in a premium that will be added on for the final sales price. So here we thought a 10% premium on the per share sales price would be a conservative assumption. And the final sales price was actually should be updated, and it was $12.3 million. So next, in looking at a discounted cash flow method of valuing this company, we started by coming up with projections. So this is into the future. It should be from 2015 to 2020 for what we expect to see Target generating in terms of net income. So these numbers were generated using a historical a average growth rate of what we've seen, and we use these numbers to get to a free cash flow to the firm. Looking at things like amortization, after-tax interest expense, net working capital, and capital expenditures in the cash flow. It's important to note that in the discounted cash flow analysis, the assumptions that we make are very heavily factor into the result, and we would need some more time to look at these assumptions and go into greater detail into creating these projections and also creating the appropriate discount rates. But what the end result of our DCF, what we're getting out of this is that the DCF is indicating an underpricing potential here, and as well as the comparable analysis. So there is potential for a good investment in target securities. So looking at some of the costs incurred now in our second alternative. So this would be to pursue a JDSA license. Our major cost would be that initial brand development campaign. So starting up, getting those initial investors in the Japanese market to buy onto your investment philosophy and join your fund. We've currently tapped that at $500,000. So these figures would be in Canadian dollars. After factoring in legal costs, license tax, recruiting costs, as well as travel costs, we have come to a total expense cost figure of around 700,000 Canadian dollars. So next we're going to weigh some of these costs against the projected revenues and what we foresee is available in this Japanese market. So again, looking at the current size of the market, 1.5 trillion yen dollars. Looking at the amount of competitors in the market and coming up with an average market share. So the average market share comes out to 6,000, again in millions, so $6 billion here. But we also wanted to take into account the minimum requirement, which you had made clear to us was 40 million yen. So our target for starting this fund would come in around 300 million yen. And that's the number that we're going to use forward in projecting these revenues, and that's the number that's going to be targeted in our branding campaign. Okay, so projecting the revenue forward 5 years, if we look at the average return that your firm has been able to obtain over the past 5 years, comes in at roughly 9%. So looking at this return on our starting asset under management, and then also factoring in new investors, so growing the firm year over year, we want to start off by doubling this firm. We know it's a lofty goal, but we think that there is the potential in the marketplace, and through proper advertising and brand management, we can do that year over year. So here we see some total asset under management figures growing through the next 5 years as we enter the Japanese market, and also the current revenue that will grow in turn. So again, these numbers are in Japanese yen, and what we've done here is we've sensitized these revenue projections. So we looked at, okay, so what if our asset under management initially is 300 million yen, and our investor growth rate only goes down to 50%. And here we can see that we're still creating substantial operating income numbers, which would outweigh the costs associated with this firm. To give you some perspective here, some of these operating income numbers in Canadian dollars range from $100,000 and upwards, using our current assumptions for market exchange rates.
Now, having a better understanding of the cost does let you know that either option could potentially be profitable, understanding the market, but this is not the sole decision criteria that we decided to use when evaluating our alternatives. So fitting your company values was one that we wanted to take to heart. So looking at the license, we would note that being able to build this company from scratch would allow you to fit your existing business model, which has proved to be successful. We also noticed that you could build this company then around the target market. Around 38.1% of people in Japan are between the ages of 24 and 50. Now, this is a great target market, especially considering the NISA is similar to what the Canadian RRSP would be. So for planning for the future, this is an excellent target market which you could build your company around. Now, when looking at purchasing target securities, we notice that they have an existing brand and an existing business model. And one thing about this is that that business model is not necessarily comparable to Orbis's business model. What we mean here is that Target is a securities brokerage, and therefore it may have different clientele and different. It may have issues when you move in, and necessarily their target market could also be quite different from what you would be looking for when expanding into the Japanese market. And when looking at the foreign culture risk that I alluded to before, for the license, you would have to deal with the regulation requirements, and you would have a lack of local expertise, but this is something we believe you can deal with. And when looking at acquiring Target, you cannot replace the employees that you have, one for regulation reasons that they would have, one for regulatory reasons, and two for social reasons. There would be backlash in that regard. And this acquisition could create employee and clientele departure from the company, which would be a catastrophic error and a problem for Orbis in that acquisition. So this is a overall view comparing our decision criteria against our alternatives. And now moving forward with our strategic recommendation, Evan is here to expand.
So in conclusion, we recommend that you obtain this JDSA1 license yourself and use that to build your own operations in Japan. That was based on the fact that we weighted the strategic fit with your company as more important than the potential benefits that you get in obtaining some cultural expertise by buying a firm. A firm like Target is so different from what you guys do and what you exceed at with Orbis that the cost of having to rebrand and bring in a new culture into that, in our opinion, outweigh the benefits and savings from the licensing process. So looking at an implementation and what that would look like, immediately in the next 0 to 3 months, Orbis has to start the process. That means first off, getting some Japanese staffing. We recommend that you use a headhunting type firm to find a director to help man the operations in Japan. That is a specific requirement needed in the JDSA1 license. And obviously beginning the license process, that means preparing any necessary documentations and finding a legal team that has experience in Japan and especially specifically with this licensing process. In a short term, 3 to 15 months, we were told that the licensing process takes about a year, so that would be the time that the process is ongoing. First of all, you have to continue to monitor it and make sure it's being fulfilled. We put it as a risk mitigation because we talked about the benefits of building your own firm over there represent a larger benefit than the cost savings of this licensing. But if it turns out to be a little too daunting and it's not going to plan, we think that it's possible to revisit the potential of acquiring a firm over there, but looking for one in the market that is a little better suited to Orbis and what you guys do than a firm like Target. Obviously then branding is huge. That's something that's going to help you hit the ground running while you're once you've got the license. We recommend that you hire a local consulting firm there to help you build that brand awareness. They have the expertise to fight the weakness that your firm has in the Japanese market without the experience there, and it would help you succeed. Finally, long term, we thought you should look to new markets. Once the Japanese firm or branch is operational and succeeding, you can use this new Asian experience to look at other markets like Korea, for example, is another very large financial market that Orbis has yet to tap into. Lastly, we also think that a mobile platform is a potential next step for Orbis in their already have a huge online presence that would help them attract a younger demographic, and especially in a market like Japan that's very technologically savvy, that would mesh well. So if we can bring back our recommendation to what we talked about earlier with the 3 pillars of doing any business in the 21st century, obviously Orbis is amazing at bringing financial management to people that it wasn't often available to for. You need as little as, I believe, $1 to start a pound to start a bank account in your London operation. That's something that is helping people build their own prosperity. Technology, you have a very simple online platform. And connection-based, obviously, you need to build trust within the Japanese market. Any type of financial management firm, trust is key. And that's why we recommend using that local consulting firm to help make those connections that are necessary. In summary, the task will be daunting regardless. It's a very different market than you've operated in before. But the benefits of building your own unique strategic model yourself, as opposed to trying to rebrand.
Stop.
Take any questions. Yeah.
You did some revenue projections. Can you talk about the fee structure being performance-based and what risks that brings along?
Right, I think it's great because it's very innovative in the investment management industry to see this kind of new fee structure. But you're really putting your money where your mouth is, and it's going to be very great for you and the company in the prosperous years. But also, again, we do see that not being limiting.
One potential benefit of your fee structure and the risk that it comes in downturns, especially when you're entering a new market like Japan and you don't have that brand awareness and client base. It's a huge marketing opportunity in a downturn, whereas you might have the financial risk will be beaten out by the marketing opportunity that people will see the benefit in your firm, that they save those fees during these downtimes.
I'm a bit puzzled by the starting AUM 300 million yen number. Where does this come from? Because even if you had, initially, say you had as much as 5 million yen per person to start out, that's still 6,000 clients you need on day one to get this number. Where does this number come from?
Right, so there is a 1-year time frame in which the fund will not be able to start up due to the regulatory process. So in that time frame, we really want to work the brand promotion. And this is why we factored in such a large part of the cost of this Japanese expansion to the brand promotion. We'd love to get into further analysis and recommendations for specific brand routes to take. We think you have a very strong brand. It's really a question of getting it out there, publicizing it. But really over a year, through a campaign of meeting with different investors, we think we can generate enough buzz, your company can, to reach that target.
So one follow-up question. How can I approach retail investors if I'm not licensed?
Right, sorry. Approaching retail investors, maybe not necessarily exactly face-to-face, but just getting that brand out there in the marketplace so that retail investors see it and recognize it is really what we should be, or your firm should be concentrating a lot of their efforts in the first year while that regulatory phase is going on.
So a huge risk to starting from time to differentiate ourselves in the saturated market. Can you expand a little bit on how you think we can stand up to competitors in that market?
Absolutely. So just alluding back to one thing that I mentioned before was that relationship-based marketing market that Japan has. And what the performance-based model that Orbis would bring to the market is something that doesn't necessarily exist in that. And what it would do is it would create loyalty and trust between the clientele and the company. And we believe this is something that would be greatly appreciated. And even in the economic downturns that may come, this would retain that clientele. So that way, when the market does bounce back and it moves forward, we believe this is something that can greatly aid and will lead to Orbis' success in the Japanese marketplace.
You didn't talk much about the funds that you're going to market. Would you market just these two funds, one of the funds, a different fund? What's the actual end product that you sell?
I think you would stick with what you know and what's been successful. You stick with your two funds that helps continue your strategy of being very approachable to any type of demographic.
Can I ask a question about implementation? So we had a number for the marketing costs, and then obviously there's going to be a waiting period. So when you're talking about growth in Korea, what's your plan for the marketing costs if we need to spend more?
Well, the growth in Korea was just sort of a long-term implementation strategy of where, once the Japan operation is running, where Orbis can look to next. In terms of the marketing cost that we put in there, it was just something that we thought was fair for the task, but that's something that can definitely be revisited with your marketing department.
Okay, are you done with that question?